Hi everyone, welcome to week 3 of Principles of Microeconomics. For this week we're going to read chapter 7 and chapter 8. Chapter 7 is going to be dealing with firms and production, and chapter 8 is going to be looking at costs and profits. When we look at chapter 7, we're going to be looking at what firms do. You'll notice that firms operate in a market economy, which the main focus is entrepreneurs and how they make money. The firms are planning organizations based off of how they should evaluate the different structures in the markets. They assign tasks, monitor those tasks, generate incentives that reward individuals for completing those tasks as well. The payoff is the amount of profits that are achieved. When we look at firms in the United States, you'll know that firms are organized primarily in 3 ways: sole proprietorship, partnership, and corporations. When we look at these 3 types of firms, you'll notice that they're very important. And many of them are organized in such a way that helps create advantageous opportunities for them. A sole proprietorship is a business that's owned by one individual, whereas a partnership is owned by 2 or more individuals, and a corporation is owned by many individuals and has a different structure with a board of governors and CEO. Some firms in the U.S. are organized as nonprofit organizations, but they're typically associated with charities. However, most firms in the United States are private, and they're profit-maximizing firms. Enterprise is the productive resources provided by an entrepreneur. The entrepreneur is the founder and often the guiding spirit of a firm. Entrepreneurs identify basic consumer demands, organize production, allocate resources, and acquire assets. Entrepreneurs are rewarded for their profits, where they have good ideas, and they try to do the best in terms of the market. And they try to bring good ideas available to the market to bring about market change. When we look at technical efficiency, we're looking at the minimum that refers to the minimizing of the physical inputs to a production method according to some specific rule. When we look at efficiency, we're trying to minimize the amount of inputs to make goods or services. When we try to minimize the amount that's being produced, that's very important to evaluate. And a market system is a way to bring about in terms of dollar terms and the entrepreneur choosing the least cost method of production. Now we have 2 different time periods that we're going to look at, and we're going to look at the short run and the long run. The short run is a time period where there's going to have at least a presence of a fixed cost. And the presence of a fixed cost is a cost that does not change when more is being produced. An example of a fixed cost could be rent. When we look at the long run, all variable costs are in the long run. That means you can change all the costs of production. And when you can change all the costs of production, that will create a lot more opportunities in the market. So when a business tries to make decisions on where to produce, they have to first evaluate both the short run and the long run, the decisions that they have to make. When we look at the short run, it's the period of time that is very short and all the outputs are varied in one or more instances. You'll notice in the short run, labor is generally the only variable factor of production, and then short run decisions are used to profit maximizing in terms of the existing plant and equipment. But in the long run, we can vary all of our costs, and when we can vary all of our costs, that brings about a lot of changes in our economy. Now, the point of diminishing returns. When we look at our resources and the point of diminishing returns, we're focused on our allocation of our resources and where the best production levels are. The principle is adding more of a variable input, such as labor, to some fixed output or some fixed inputs, going to create challenges in markets, and the challenges that are going to be created in the markets are going to have less and less output marginally than before. When this occurs, this is the principle of diminishing returns. It's very important to evaluate. And when you look at this principle, you're applying it to both the short run, and you can apply it sometimes to the long run, but mostly to the short run because of the presence of the fixed cost that's available. Now let's focus our efforts on the cost of production of a firm. and we look at the cost of a production with the firm, you'll notice that we're going to be looking at how firms will make profits. Now, we can make profits in two different ways, with accounting profit and economic profit. When we look at accounting profit, we're focused on the difference between total revenue and explicit costs. This is the profit that's reported for tax purposes. And when we look at explicit costs, these are costs that we can measure in an economy. That's very important. When we look at implicit costs, those are going to be costs of production that we're not able to measure. Economic profit is the difference between total revenue and the explicit cost of production, plus the implicit cost of production. So economic profit is looking at the opportunity cost involved. An entrepreneur who does not earn a profit that is less as at least equal to his or her opportunity cost, they're going to quit the endeavor. And that's very important to evaluate. When we look at opportunity cost and normal profit, you're going to look at the cost of capital, and that's referred to as normal profit. Normal profit represents the rate of return that's necessary to keep capital and enterprise in an industry. When we look at the correct definition, it's important to use both costs and profits to predict the behavior of what firms will do. Firms will dictate their decisions based off this. Then we have some more short-run costs that we need to evaluate. When we look at total costs, it's simply the sum of all the costs of production and the different two types of costs that we need to look at: fixed costs and variable costs of production. Total fixed costs are the cost of the fixed inputs, and the fixed costs are only present in the short run because of the presence of some costs that we cannot change. When we look at total variable costs, they vary with output. Variable costs increase as more is being produced, and when we look at more variable costs, we're looking at how these variable costs will change when more is being produced. Firms have to evaluate their variable costs and their fixed costs, but you'll notice if you want to produce more, variable costs will increase. Then we have the average fixed costs, average variable costs, and average total costs. When we look at the averages of anything, we're going to divide them by output. And when we divide by output, that's going to create a lot of challenges. You'll notice that the average variable cost and total cost will go through a U-shaped relationship, whereas the average fixed cost will always be decreasing, I should say it that way. So now let's look at these curves right here. Here's some differences in cost curves. If you look at this curve, you have the total cost right here, and you have the total variable cost. The difference between these two curves is the fixed costs that's present. Is the fixed costs that are present, and also it's illustrated by this curve right here. Now we look at this graph. This is looking at the marginal and average cost curves. Here's the average cost. You notice that U-shape. Here's the average variable cost, same U-shape. The difference between these two curves, the average cost and the average variable cost, is the fixed costs that are present in the market. When we look at the differences in these markets, you notice we're going to be facing a lot of challenges. And when we look at it, you'll look at this marginal cost curve. And that marginal cost curve is very important to evaluate. The marginal cost curve is going to be looking like a check mark or a Nike symbol. And when we look at it, you'll notice that they will always cross the average cost at their lowest level. That's important to evaluate. Now, let's look at the long run. And when we look at the long run, we're going to look at resources. And you're going to look at costs in the long run. You're going to notice that plant size is represented by the point where all of the short run costs are at their lowest point. And this is tangent to the long run average cost curves at its minimum. We're going to be looking at the long run costs and making decisions on where we should evaluate these changes. And long run cost curves are very important to look at because firms will operate many different decisions in the long run. You'll notice here's the long run average cost. And you'll notice these long run curves are based on these little short run curves that are tangent to the long run. And we have to focus on where firms will want to operate. Firms will want to operate when they can produce the most output at the least amount of costs, and that's very important for them. When you can find that production cost, that will bring about a level where it will be advantageous in the market. So these were some of the concepts that we're going to focus on this week. If you have any questions, please let me know, but I look forward to your effort.